Welcome back. We are busy with Class of Business 7 investments. We are now moving on to Unit 3. We will discuss the different types of investment vehicles. Right, as introduction, the importance of asset allocation was highlighted in the previous section, and that is the primary determinant of how an investor's portfolio will perform. Once the decision has been made, the investor can then decide on which investment vehicles will be used to achieve their investment objectives. Surprisingly, most investors tend to start by chasing several investment vehicles in which to invest and leave the most critical decision or asset allocation to chance. This wide array of investment vehicles can confuse a potential investor, and care and due diligence needs to be exercised in choosing the right vehicle. An investment vehicle is a product used by the investor to have a positive return. An investment vehicle should not be confused with an asset class. An investment vehicle is merely the basket in which the various asset classes are invested. For example, a person may invest in equities through direct shares, or a collective investment schemes, or an endowment, or a retirement annuity, or a living annuity. Investors often get confused between these two concepts and make comments such as, "My retirement annuity is not performing." The distinction between the two must be made very clear. A practical example may help to clarify this point. Over the past 116 years, South African equities have given an annual average return of over 12%. However, there have been periods where the returns have been negative. Over these periods, an investment in cash or bonds would have outperformed an investment in equities. Extend the comparison to a 10-year term horizon, and the position will likely look quite different. With the best will in the world, an equity fund will not do well in a period when markets are in decline. Likewise, no matter how competent and fixed interest manager is or may be, they will likely outperform an equity manager over the long term. An investment vehicle can be low risk, such as certificates of deposits or CDs, or bonds, or carry a higher degree of risks, such as stocks, options, and futures. Other investment vehicles include annuities, collectibles like arts or coins, as we discussed, mutual funds and exchange-traded funds or ETFs. The term investment vehicle therefore refers to a method by which individuals or businesses can invest and grow their money. There is a wide variety of investment vehicles, and many investors choose to hold at least several types in their portfolio. It can allow for diversification while minimizing risks. Right, let's discuss the following investment vehicles. The one is the RSA retail bonds, collective investment schemes, linked and market-related investments, investment trusts, guaranteed products, multiple or multi-manager funds, interest-bearing investments, insurance as an investment, shipping containers as an investment, hedge funds, exchange-traded funds or ETFs, contracts for difference or CDs, and foreign and or international investments. Right, let's have a look at the first one, retail or RSA retail bonds. In 2004, the government of South Africa, through the National Treasury, started issuing retail bonds to the general public. In November of 2018, the following interest rates applied to the retail bonds. For 2 years, 8.25, 3 years, 8.75, and over a 5-year period, 9.25%. Now, National Treasury also issued inflation-linked bonds. The applicable rates as of November 2018 were as follows. 3 years inflation 2.5, 5 years inflation 2.75, and 10 years inflation 3%. Investors can withdraw from the investment before the maturity date. The following rules will then apply to the withdrawals. After 12 months, you will pay a penalty equal to a percentage of the interest calculated on the amount withdrawn, which will be deducted from the amount. A balance of 1,000 should remain if the total investment is not withdrawn. Within the first year, only in extraordinary circumstances, you must write a letter to the National Treasury to motivate this early withdrawal. The penalty will be deducted from the amount payable to you on such an early withdrawal. The penalty shall be a total forfeiture of all interest accrued and or previously paid to you on the amount to be withdrawn. An investor can nominate one or more beneficiaries on death. The nominated beneficiary will be paid out the capital balance that's available in the bond on that date. Suppose the RSA retail bond owner dies before the expiry date of the savings without nominating a beneficiary. In that case, the ownership of the investment shall, at the executor's request, either be transferred to the deceased estate or paid in full to an account determined by the executor. If the RSA retail bond owner had nominated a beneficiary, it would then be paid to that specific beneficiary. Investors over the age of 60 may draw interest on their existing fixed rate bonds. The introduction of inflation-linked bonds gives investors added flexibility as they can decide whether traditional bonds compensate them for the inflation risks or not. The government introduces these retail bonds geared to similar investors to encourage saving. The interest rates are competitive, especially for smaller investors, and compare favorably with a fixed deposit issued by banks. The other advantage is that these bonds are available in small denominations, a minimum of R1,000 per bond. However, there is a limit to how much an individual may invest in them annually, namely 5 million. Only South African citizens or permanent residents can purchase these bonds. Treasury now also offer retail investors inflation retail savings bonds for 3, 5, and 10 years. The capital value of the bond is adjusted for inflation every 6 months. The interest earned is then calculated on the adjusted value. At maturity, the investor is paid out the inflation adjusted value of the bond. The interest rates on the RSA retail bonds are priced off the bond yield curve. The prevailing interest rates of the retail bonds will be fixed from purchase until maturity. If the rate moves more than 50 basis points during a month, new rates will be determined for the following month. The new rates will be published on the RSA, the retail bonds website, and in the newspapers. The public can then buy 2-year, 3-year, or 5-year maturity retail bonds. They can also combine these 3 bonds with a minimum of 1,000 per bond. Thank you for attending this session on the various financial plans and ways that you can invest your money, and then especially the RSA retail bonds we discussed. In our next session, we will look at collective investments. That will be Unit 3.1. Thank you. See you in the next session.